Dhiraj Agarwal is our market master today, Managing Director at Ambit Investment Managers. Dhiraj, good morning. Great to have you with us here. Thank you for your time. I mean, the banks are essentially what have come back the fastest. The Nifty bank is about 2% from its all-time highs, Dhiraj. What's the environment like? I mean, 2024, news channels, we look at the end of the year, we look at what have been the big themes. One of the big themes that we kind of identified is that 24 has been the year when the central bank really cracked the whip in terms of asking financial entities to toe the line, both in letter and spirit. Right? So much happened there. Do you think 25 maybe we'll see, them taking the foot off the pedal a little bit more easy, light touch regulation, or you think it'll be as tight and as hard?
It's a difficult thing to forecast, right? I mean, I don't really know what's RBI's mind at this point, but it looks like and RBI's or the regulators' strictness, for the want of a better word, on the sector has been long coming, because it's not that they've suddenly tightened on the screws at this point of time. They've been actually warning about rampant growth in unsecured lending book of the banks as well as NBFCs, and they've been slowly indicating that this is a risk that we've been watching. So them coming a little bit harder on trying to prevent something untoward happening in that space at this point of time was not totally unexpected. And I don't really think, I mean, there might, so there are two different parts to it, to your question. Would there something to ease the liquidity in the system? Perhaps yes. Would they ease the regulation to undo what they have done in the last few months? I think not. I think unsecured lending is perhaps still in a little bit of a risk area, not for everybody, but for some people. And RBI will continue to watch it very closely, I think.
Okay. You just put up the Vodafone Idea stock. That is now I think it started higher. The pre-open, at least, we were looking at it up being about 10%. Vodafone Idea, if you will. I think the high has been, you can't see it, but there was a sharp ramp up. The high was made at about 8 rupees 79 paise. And it's just a complete collapse since then. And now we're about 8 rupees and 30 paise or so. That's down 1.5%. So it's a big move which has happened already within the first 5 minutes or so of trade. So that's Voda Idea. And the second one is Indus Tower. Maybe we could just quickly look at that one as well and see if that has also given up gains. That is also come off very sharply. Look at that. Indus Tower, I think the high has been made at, the high is at about 375. And the stock's at about 360 now. So both Indus and Voda, after a sharp ramp up, selling off very, very hard. Surabhi.
Okay. The analyst told us, right, that incrementally, what does it do? Voda Idea, they have far bigger issues than, a little bit of money that's coming in. And even that 2,000 crores that comes into Voda Idea, they anyway will have to give it off to Indus to pay off the dues. And for Indus, why is that not too much of a hurrah moment? Because like the Axis analyst told us, that it was anyway being penciled in that Voda will pay. Maybe with its internal accruals, but it'll pay in the next couple of quarters. Now it just gets accelerated with the fund infusion happening from Vodafone PLC. Dhiraj, hi, great to have you on. I have a question around this whole FPI selling business, right? Last couple of days have been a little better. We've got some buying, 2,000 crores odd buying coming through. What's the chatter you're hearing? I mean, this home market bias is still so strong, right? You can buy stocks in America, buy bonds in America, now buy crypto in America. So one can understand the compelling reason to be in the US. So where do we figure in the larger scheme of things as we get into the new year?
So, I mean, while there are two parts to it. So while India's weight in the emerging market indices is now quite high, 18, 19%, very close to China. One should keep in mind that our weightage in the global benchmarks are still in the 5% kind of a range. So from most global funds point of view, we are still quite small from that perspective. And hence, India literally becomes from most, I mean, there are about 27, 28 or about 30 odd $1 trillion of total equities under management globally. And India has a high holding to There would be about $1 trillion. Just India, from a global standpoint, still forms a little bit of a diversification, a little bit of that additional zing that you add to your portfolio because it's a faster growing economy and you can find stocks here which can beat the benchmarks, etc. So it's becoming a little bit more of a bottom-up market. So my sense on the FI selling is, I mean, it's very difficult to pinpoint the exact reasons, but with the US elections, there were greater expectations of tax cuts and hence US companies doing better in the short run. There were perhaps expectation of dollar strengthening even further, which is always negative at the margin for the leverage money which might have come in. Mind you, I mean, that's not all of the FI money which is coming, right? So the leverage play is always small and at the margin, and it tends to come in and go out very fast. And maybe bulk of it has already moved out and we are back to status quo and back to business as usual. So I think global investors will keep India in their portfolio despite a strong home bias and despite a very strong performance in the US market at this point of time, because there are opportunities here which can do better and are doing better than even some of the benchmark large cap names in the US.
Hi, Dhiraj. Good morning. Good to see you in. No, I'm not going to ask you about Zomato, but what about Swiggy? Is it looking enticing enough? 55-60% discount in valuations in comparison to Zomato. And the management intends on doing the right things. They're sitting on cash as well of around 8,800 crores, and they sounded quite optimistic when they joined us yesterday. Do you believe that this can narrow the valuation gap with Zomato?
It's a tricky call. So without commenting on the valuation specifically, one thing I can say is that Zomato, in terms of their performance metrics, is way, way ahead of Swiggy at this point of time. And that's what the valuation gap shows. And Swiggy will have to do a lot more work to bridge that gap, if at all. So it's not easy. It's not easy. Zomato has taken a big lead. Blinkit, which is now the current driver or large driver of Zomato's valuation, is doing exceedingly well and much better than the peers. So the valuation gap is largely due to the performance difference as well.
So you stick to what you liked in the past then? Dhiraj, you would rather stick to what you liked in the past?
That's right, yes.
Okay.
Stick with the leader, stick with the top market share company, unless there are some strong reasons to change. I mean, just chasing valuation gaps is not usually a good idea.
Dhiraj, okay, so got it. So Zomato remains your top choice. And I'm pretty sure we're not going to speak again before the end of the year, Dhiraj. So tell us, give us, two scintillating ideas for 2025. Okay, maybe Zomato is one. Give us two more, so that'll make it a nice three.
And just to set the record straight, I mean, I never said Zomato is one of my topics. I like the company. And
businesses that you like. I'm not asking for a specific buy call on a stock.
Yeah.
But, businesses that you like, companies which are doing a great job and you think there can be a value created.
See, at this point of time in the market, the one message that I want to leave for 2025, instead of going into specific stocks, is that the biggest learning from the October sell-off for me was that the companies, even if the companies which are very, very loved in the space right now, if there was even the slightest amount of earnings disappointment, the stocks were getting punished really, really hard. So what this tells me is that in many of the loved sectors, the valuations are priced to perfection. And hence, going forward, narratives will not work. It will be numbers which will drive the stock prices in the markets, which will make stock picking harder than what it was in the last 3 or 4 years. We'll have to focus on numbers with a microscope. And gone are the days where just because a company is loved, just because the story is loved, even if the numbers don't come in, the stock prices keep going up. So that environment has certainly changed. And that's what my key message is. At this point of time, it's very difficult to say which sectors will do well and not do well. I think it's more about which individual stocks within those sectors are delivering the numbers and can actually outshine. So 2025, I forecast or I see a market of huge dispersion, where within a sector, you might see stocks falling 20-25% and stocks running 25-30%.
So it's going to be the year of a stock picker. Can't paint everything with the same brush. All right,
Absolutely.
Dhiraj, great speaking with you, and wish you a very happy new year in advance, and look forward to more conversations in 2025.